Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Knowles Corporation Annual Report. Knowles Corporation offers a diverse range of products and services across various industries. The company operates in two main segments: Precision Devices, PD, and MedTech and Specialty Audio, MSA. The PD segment provides high-performance capacitor products and RF solutions to the defense, industrial, MedTech, and electrification/energy markets. This includes film, electrolytic, and mica capacitors used in various applications such as medical devices, defense systems, and industrial equipment. In addition to capacitors, Knowles Corporation also offers radio frequency, RF, and microwave filters, which are crucial components in the development of communication systems and other electronic devices. The company's expertise extends to balanced armature speakers and microphones, designed for hearing health and specialty audio applications in the medtech and industrial markets. The MSA segment focuses on designing and manufacturing high-quality speakers and microphones that cater to the needs of various industries, including medical technology and industrial sectors. Knowles Corporation serves its customers through original equipment manufacturers, contract manufacturers, suppliers, sales representatives, and distributors across Asia, the United States, Europe, rest of Americas, and internationally. The company's products and services are in high demand due to their precision and reliability, making them essential components in various applications such as electric vehicles, defense systems, medical devices, and industrial equipment. With a rich history dating back to 1946, Knowles Corporation has established itself as a leading provider of specialized electronic components and solutions. Knowles Corporation's stock price has experienced a significant increase over the past year, rising by nearly 48% due to strong financial performance and optimistic outlooks. The company's consistent delivery of positive quarterly results has been a key driver of this growth. In Q1 2025, Knowles reported revenues at the high end of its guided range and exceeded cash from operations expectations. This was followed by even stronger results in Q2 2025, with revenues increasing 8% year-over-year and non-GAAP diluted EPS beating forecasts. The company's third-quarter results were also impressive, with revenues up 7% year-over-year and net cash from operations at the high end of guidance. The final quarter of 2025 saw Knowles deliver its strongest performance yet, with a 14% year-over-year increase in Q4 2025 revenues to $162 million. The company's full-year revenue grew 7%, surpassing its 5-year organic growth target. This series of positive financial reports and outlooks culminated in Knowles Corporation's stock reaching a 52-week high of $27.40 on February 9, 2026. The company's strategic transformation into a high-margin industrial technology company has also been a significant contributing factor to its improved performance and market positioning. The divestiture of its consumer MEMS microphone business in December 2024 marked the beginning of this transformation, which is expected to drive continued revenue and earnings growth in the future. Knowles Corporation maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Knowles Corporation trades at a higher price-to-earnings ratio of 47 times and a higher price-to-book ratio of 2.98 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 32% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth are primarily attributed to increased demand from various markets such as medtech, defense, electrification/energy, and industrial. Higher shipping volumes, product cost reductions, and factory capacity utilization in ceramic capacitor and RF filter businesses also contributed to the growth. Additionally, higher average pricing, reduced precious metal costs, and transactions with Syngent further boosted revenue. On the other hand, revenue decline is mainly driven by impairment charges and restructuring charges, as well as the sale of discontinued operations, CMM. The amortization expense for intangible assets decreased, resulting in a lower revenue. Restructuring and exit costs also increased, contributing to the decline. Other factors that affect revenue growth or decline include tariffs and trade restrictions, changes in international trade policy, export restrictions, economic sanctions laws, fluctuations in commodity prices, and foreign currency rate fluctuations. These external factors can have a significant impact on revenue, making it essential for companies to adapt and respond accordingly. Net income and profit margins. A changing landscape, the net income of the company underwent significant fluctuations between 2023 and 2025. In 2024, it decreased by a staggering 64% from $42.7 million to $15.1 million, but then increased by an impressive 118% in 2025 to reach $73.3 million. This substantial increase can be attributed to the reversal of deferred tax valuation allowance in 2025. Profit margins also experienced changes during this period. The gross profit margin decreased from 44.6% in 2023 to 42.4% in 2024, but then increased to 43.2% in 2025. Similarly, non-GAAP gross profit margins saw a decrease from 45.5% in 2023 to 44.3% in 2024, before increasing to 44.4% in 2025. The reasons behind these changes are multifaceted. The decrease in profit margins in 2024 was largely due to goodwill impairment charges, lower revenue, terminal growth rates, higher income taxes, and increased capital expenditures. In contrast, the net income increase in 2025 can be attributed to a single factor, the reversal of deferred tax valuation allowance. The company's financial performance is a key indicator of its overall health and stability. A review of the operating cash flow reveals a positive trend over the past 3 years. In 2025, the company generated $114 million in net cash provided by operating activities, a decrease from the previous year, but still a significant amount. A closer look at the data shows that the company's operating cash flow has been steadily increasing since 2023, with a peak of $130.1 million in 2024. Although there was a slight decline to $114 million in 2025, this is still a positive indication of the company's ability to generate cash from its core operations. Overall, the data suggests that the company is generating sufficient operating cash flow to support its business activities and investments. This is a crucial aspect of financial health, as it allows the company to invest in growth initiatives, pay off debts, and maintain liquidity. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, there was a notable increase in debt level due to the acquisition of Cornell Dubilier and the issuance of a seller note worth $122.9 million. However, this trend reversed as long-term debt decreased from $134 million in 2024 to $114 million in 2025. This reduction in debt level is a positive development for the company. In terms of interest expenses, there are conflicting reports. On one hand, some pages indicate a decrease in interest expenses by up to 42.9% from 2024 to 2025. For instance, page 24 shows a decrease of $7 million, while page 27 and 41 report a net interest expense of $9,300,000 in 2025 compared to $16,300,000 in 2024. On the other hand, pages 49 and 62 show an increase in interest expenses from $8.1 million to $4.8 million and $9,100 million to $5,800 million respectively. Overall, while there are discrepancies in the data, it appears that the company's debt level has decreased significantly, but its interest expenses have been inconsistent, with some reports indicating a decrease and others showing an increase. The company's performance can be analyzed through its segments and regions. In terms of segments, the Precision Devices (PD) segment stood out as a strong performer in various markets such as defense, industrial, medtech, and electrification/energy. On the other hand, the medtech and specialty audio (MSA) segment did not provide any information on its performance. Moving to regional analysis, both the United States and Asia performed well, contributing 42% and 38% of the total revenue respectively. The United States generated $248.8 million in revenue, while Asia generated $226.1 million. Unfortunately, there is no specific information available on the performance of Europe. Management is optimistic about the company's outlook, citing growth opportunities in key end markets such as defense, medtech, and industrial sectors. The company expects to generate positive cash flow from operations and has secured a revolving line of credit to support its future growth plans. The company's strategy focuses on innovation and customization to stay competitive in the specialty electronic components industry. It has shifted investment towards emerging trends and has secured favorable positions in key markets. Management is also committed to managing risks, including supply disruptions and loss of key customers or distributors. In terms of financial performance, management expects the non-GAAP effective tax rate, ETR, to increase due to fully utilized foreign tax credits. The company has a share repurchase program with $129 million remaining, which it plans to continue based on market conditions. Overall, management's outlook is positive, driven by growth opportunities in key end markets and a commitment to innovation and risk management. The company's financial strategy has been focused on rewarding shareholders through dividend payments. As per the provided information, the company has indeed paid dividends to its investors, as mentioned in pages 24, 28, and 51 of the report. In addition to paying dividends, the company has also implemented a share buyback program. This initiative allows the company to repurchase its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing the value of each remaining share for investors. Concerns about inventory buildup or supply chain disruption are evident throughout the extracted summaries. One of the primary risks identified is the potential for suppliers with facilities in countries viewed as strategic adversaries to pose a threat, page 3. Additionally, the loss of a single supplier could have a significant impact on operations, and identifying an alternative supplier may be challenging, page 4. The industry's economic downturn or other factors can lead to oversupply of inventory at distributors, resulting in reduced sales, page 7. Highly specialized suppliers pose a risk of supply disruption or capacity constraint, while sole source suppliers could cause material adverse impact if unable to deliver materials or components in a timely manner, page 8. External factors such as labor unrest and strikes, natural disasters, health crises, acts of terrorism, political or economic instability, government embargoes, trade restrictions, and import/export controls may also disrupt supply chains, pages 11-12. Tariffs and trade restrictions can increase the price of raw materials and affect customer demand, further disrupting supply chains. Furthermore, production transfer costs and acquisition-related costs on page 29 indicate concerns about inventory buildup or supply chain disruption. Distributors retaining inventory levels that exceed their future anticipated sales are also a concern, page 35. The value of inventory may decline due to surplus, price reductions, or technological obsolescence, with an inventory balance of $124.6 million net of reserves, page 40. Overall, these concerns highlight the potential risks associated with inventory buildup and supply chain disruption, emphasizing the need for careful management and mitigation strategies. That concludes the financial summary for Knowles Corporation. Feel free to comment below, and I will be happy to answer them when possible.